Reminiscences of a Stock Operator by Edwin Lefèvre. Today's audio is about Reminiscences of a Stock Operator, the biographical novel of Wall Street's king of speculation, Jesse Livermore. In this book, we see how Livermore's turbulent speculative career, with its billion-dollar losses, distilled survival principles for the stock market: befriend the trend, be your own adversary. First, let's explain the term operator. Originally, it means a skilled person or an expert, but here it refers to a market insider who makes a living from trading, wielding significant influence in the market. The stock operator in the book's title refers to Jesse Livermore. Born in 1877, Livermore was active on Wall Street from the late 19th century to the 1930s. In a public poll initiated by the New York Times in 1999, he was voted the most important stock market figure of the century by a large margin, surpassing even legends like Warren Buffett, George Soros, and Peter Lynch. Just how legendary was Livermore? With only an elementary school education, he entered the market at age 14 with $5, made $1,000 by age 15, and became a millionaire by age 29. At age 52, during the 1929 stock market crash, while others lost fortunes, he bet on the market's decline and made $100 million in a few days, equivalent to billions today. At this rate, Livermore should have become the world's richest man, right? No. Less than 5 years later, he went bankrupt again, and this was his final major bankruptcy. A few years later, he died by suicide. How did Livermore, with only a primary school education, become a Wall Street legend? Why did such a brilliant person go bankrupt multiple times and ultimately end his life? The answers lie in Reminiscences of a Stock Operator. This book was written by Wall Street financial journalist Edwin Lefèvre, based on Livermore's own accounts. It began serialization in newspapers in 1922 and was compiled into a book the following year. As a biographical novel, it realistically chronicles Livermore's experiences, although some parts are fictionalized by the author. Nonetheless, this book is widely regarded as the best resource for understanding Livermore's life and investment philosophy. Many editions of this book credit both Lefèvre and Livermore, while some even credit Livermore alone. In the book, Livermore is referred to as Larry Livingstone for narrative convenience, but we'll use Livermore to refer to the protagonist for clarity. This book is considered an encyclopedia of the stock market ecosystem. Although it discusses the U.S. stock market over 100 years ago, its insights are highly relevant to today's financial markets. Its profound depiction of human nature has led it to be called the only book about stocks that non-investors need to read. Introduced to China in 1998, it has had at least 20 editions in 20 years, averaging one edition per year, and is a staple for seasoned stock traders. Every sentence in the book's table of contents encapsulates lessons learned by Livermore over decades of market experience. These lessons are frequently quoted by generations of investment masters. For example, knowing what not to do is more important than knowing what to do. First, do the right thing, making money will naturally follow, and stock market battles are not contests between people, but between perspectives. This audio will summarize Livermore's lessons into 3 major stock market survival rules. 1. There's nothing new on Wall Street because human nature never changes. 2. The market is never wrong, befriend the trend and go with the flow. 3. The one who makes mistakes is always oneself, be your own adversary and overcome human weaknesses. Let's start with Livermore's first rule: there's nothing new on Wall Street because human nature never changes. We know Wall Street houses America's leading financial companies. For over a century, Wall Street has been synonymous with the U.S. and global financial industry, witnessing countless remarkable stories. However, Livermore said, speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. Whether in Livermore's era, decades before his time, or in today's global financial markets, bull and bear markets repeat, financial giants rise and fall, generations of stock market legends experience ups and downs, and only a few consistently make money. Daily dramas of joy and sorrow unfold, only with different names and places. Nowhere else does history repeat as frequently as on Wall Street. Why is this? Because markets are made up of people, and human nature is inherent and unchanging. Regardless of the era, market changes are driven by human greed, fear, ignorance, and hope. These human traits become fatal weaknesses in the investment world. Everyone enters the stock market out of greed, to make money, but with stocks constantly rising and falling, your portfolio value fluctuates, affecting your emotions. When the market goes against you, you hope every day is the last day of loss, holding on and losing more. When the market favors you, you fear losing profits the next day, hastily exiting and missing out on potential gains. This recurring greed and fear mean there's nothing new in the financial markets. Hence, Livermore believed that to survive in the stock market, one must learn from history and from their own mistakes. First, learn from history. At 14, Jesse Livermore started working at a bucket shop, recording real-time stock prices, earning $5 a week. Bucket shops were essentially gambling dens. People didn't actually buy or sell stocks, they bet on price movements. If you bet $1 on a stock rising, you earned $1 for every dollar it rose, and 10 times your bet if it rose $10. But if it dropped $1, you lost your bet. Gamblers could bet and settle anytime. Bucket shops made steady profits through high transaction fees and probability advantages. Gamblers' chances of guessing right were much lower than half. Even if they guessed right this time, continuous play meant eventual mistakes. The most crucial factor was emotion, human greed, and fear. Gamblers losing money would try to recover losses, losing more, while winners, reluctant to stop, would eventually be harvested by market fluctuations. Yet Livermore, a mere child, thrived in the bucket shops, almost always winning. By 15, he had earned $1,000, equivalent to several years of wages. On one occasion, he made as much in 2 days as 300 gamblers contributed in profits over 2 weeks. How did Livermore achieve this? With exceptional memory and a natural affinity for numbers, he discovered patterns in stock price movements through meticulous records and analysis. He noted that before rising or falling, stock prices exhibited certain recurring fluctuations. For instance, a specific pattern preceded an 8 to 10-point rise. Behind these prices were people competing, and human nature caused repetitive behavior, reflected in the price quotes. Over time, Livermore could predict stock price movements with impressive accuracy based on these patterns. Essentially, he had developed a predictive algorithm. I must emphasize that the book's portrayal of Livermore's algorithm might be somewhat dramatized. Even if true, such methods would be impractical in today's vastly larger stock markets. Nonetheless, Livermore's approach of learning from history, identifying patterns, and using them to predict the present and future is valuable. In addition to learning from history, investors should learn from their mistakes. Livermore quickly realized that the best way to learn what to do and what not to do in the stock market was to lose everything. Losing money isn't the problem, failing to learn the lesson is. By the time he was 20, Livermore had made $10,000 from bucket shops. However, as his wins piled up, bucket shops blacklisted him, cutting off his income. He turned to Wall Street, the hub of stock trading. But within days, he was bankrupt. Why? Back then, stock trades were manually executed. Quotes had to be telegraphed nationwide, causing delays, and recorded on blackboards by runners. By the time your order was executed, prices had changed. Livermore's algorithm predicted price movements accurately, but delays rendered it useless. If you expected a stock at $100 to rise, the actual buy price might be $105, drastically increasing costs. Selling also involved delays. Previously, guessing 1 or 2 points was enough to profit. Now, he needed to be right by 5 or 6 points. Initially unaware of these new rules, Livermore lost everything quickly by overtrading in desperation. After rebuilding his capital, Livermore returned to New York, mindful of quote delays. He operated cautiously and, during a bull market, amassed $50,000. Yet, within 2 days, he lost it all despite accurate predictions, due to unfamiliarity with new rules. Approaching a market peak, Livermore bet all his funds on a stock's decline. The stock plummeted, but delays meant his orders executed far below expected prices. Seeing an overreaction, he reversed his position, only to encounter similar delays, losing another 15 points. This cycle quickly led to bankruptcy again. These repeated mistakes highlighted the importance of understanding market rules. Without this, trading would inevitably lead to losses. Livermore's second rule: the market is never wrong. Be friends with the trend and go with the flow. In the stock market, average investors often don't want to put in the effort to think critically. They just want to know which stock will make them money and are keen on getting stock tips or inside information. When they make money, they credit their own smarts, but when they lose, they blame others, complaining about market manipulation or how bad the market is. Livermore, however, was the exact opposite. He never blamed the market or others. Instead, he constantly reflected on his own mistakes, learning and evolving from them. He famously said, "There are two sides to everything, but the market only has one side. The market is never wrong, only people are wrong." Years of experience taught Livermore that while one may occasionally outsmart a particular stock, no one can outsmart the market. As mentioned earlier, Livermore went bankrupt twice after entering the real stock market. But rather than giving up, he refined his strategies to better fit the rules of the game. Previously, at the bucket shops, he only needed to predict the price movement over the next hour or even the next minute. Now, on Wall Street, he set his sights further, focusing on medium to long-term trends. This not only helped him avoid losses due to price reporting delays, but also made making money seem effortless. This was a major shift in Livermore's thinking. He realized that to survive in the market, he must follow the trend. Here's a quick lesson on some basic financial market terms. In the market, we often hear about being bullish or bearish. Being bullish means expecting prices to rise, while being bearish means expecting prices to fall. Going long involves buying at a low price and selling at a higher price, while going short involves selling at a high price and buying back at a lower price. Bulls are the buying force, while bears are the selling force. In the stock market, it doesn't matter whether you side with the bulls or the bears. What matters is that you side with the market. Think of it like riding an escalator. If you want to go up and you're on an upward-moving escalator, you'll reach the top even if you don't move. But if you're on the downward-moving side, no matter how hard you run, you may not get up there. Even someone as skilled as Livermore would lose badly if he went against the trend. This brings us to another instance of Livermore's bankruptcy. In 1906, when Livermore was not yet 30, he had already spent 15 years navigating the market and was steadily making profits. That year, while the market was booming, Livermore noticed that the economic environment was poor and there was a shortage of money, making it hard to sustain the bull market. He predicted a crash was inevitable and began shorting the market heavily. Although his prediction was correct, he went bankrupt once again. The reason? He was ahead of the market, acting before the market actually turned, and was caught off guard by the trend. Livermore learned another lesson: predicting correctly isn't what matters, it's acting at the right time and getting money into your pocket. You can only achieve more with less effort when you patiently wait for the market trend to align with your position. The following year, Livermore finally saw the signals of a market collapse. Borrowing money from a securities firm, he shorted heavily and successfully made $1 million. As the market crashed and everyone was in despair, the financial titan J.P. Morgan himself had to ask Livermore to stop shorting the market. There is a common rumor among investors that big swings in the market are controlled by top traders like Livermore or Soros. But Livermore himself clearly denied this. He believed that no one can control or outsmart the market. The big winners don't create trends, they act according to existing trends, making the market their ally. You might say, I know I need to follow the trend, but it's too difficult to do in practice. How do I identify and use the trend? Livermore had 2 tricks for this. The first trick for identifying trends is to look for the path of least resistance. We know that stock prices are the result of the combined forces of buyers and sellers. Whichever side, bulls or bears, has more money and strength will push the price in their direction. In other words, prices move like water, flowing where the resistance is weakest.
For example, if a stock has been declining for a long time and is now very cheap, and the external environment is favorable, the people who wanted to sell have already sold, those who remain are unwilling to sell, so even bad news won't push the price down much. But if there is good news, people start buying in large amounts, and the price rises significantly. In this scenario, the path of least resistance is upward. Pay special attention to signals from key price levels, like round numbers such as 10, 100, or 130, or historical highs. Once these levels are breached, more people and money are drawn in, accelerating the price increase in just a few days, far more than the gains made over the past several months or even years. Let's look at a case involving Livermore in the wheat futures market. At the time, someone asked him what he thought about wheat's price trend. Livermore replied that the right thing to do was watch and wait until the price exceeded $1.20. Someone asked, "It's $1.14 now, which is cheaper, why wait for a higher price? Won't that reduce your profit?" Livermore answered that while the current price is low, there's no certainty it will rise. Instead of blindly betting, it's better to wait until the trend forms. Earning a little less is fine, I want safer profits. Over the next few months, wheat prices fluctuated between $1.10 and $1.20. Finally, one day it exceeded $1.20. Only then did Livermore start buying, and the price indeed rose quickly. He continued to buy more, expanding his profits.
While most people believe in buying low and selling high, Livermore preferred to go long at high prices and short at low prices. It may seem illogical, but once he identified the trend, he hitched a ride to make big, stable profits. The second trick for using trends is to go long in a bull market and short in a bear market. Livermore once met an old man who resembled a character from a martial arts novel, The Quiet Monk Who Sweeps the Floor. The old man appeared unremarkable, spoke little, never sought insider information, and never complained. He was said to have made a lot of money in the stock market. One day, a young investor recommended a stock to him. A few days later, the young man excitedly told him, "It's up 7%. Sell it now." But the old man, smiling calmly, waved his hand and said, "If I sell, I'll lose my position. This is a bull market, you know." Livermore considered this the best lesson he ever received. You can't make big money by relying on small fluctuations, you have to rely on the big trend. Many small investors in bull markets only earn the index, not the money. The reason is they constantly buy and sell, switching stocks in an attempt to catch every rise and avoid every dip, but they miss out on the big bull stocks and major price movements. In reality, the best strategy in a bull market is to buy and hold. Stock trends are driven by market money and sentiment. Once a trend forms, even though there may be fluctuations and reversals, it will generally maintain a large direction for a certain period. Even unexpected events tend to align with the trend. In a bull market, everyone only sees good news, bad news is ignored, and even bad news can be interpreted as good. In a bear market, bad news is magnified, and good news is ignored. Under these circumstances, the best approach is to follow the big trend without wavering. Livermore's third survival rule is, be your own enemy, overcome the weaknesses of human nature, and don't trade stocks like a normal person. We know that Wall Street, as the most lucrative place, gathers elites from around the globe. Does this mean that to excel in investing, one needs high IQ and advanced degrees? If that were the case, the richest people in the world should be university professors. But this is not true. On the contrary, many highly intelligent people perform worse than average in investing. For example, the great scientist Newton suffered a huge loss in a stock market bubble, losing £20,000, equivalent to millions of yuan today. He famously remarked, "I can calculate the motion of heavenly bodies, but not the madness of people." Contrarily, Livermore, who only attended elementary school, grew into a legendary stock trader. Renowned fund manager Peter Lynch once said, "To succeed in investing, you only need to be able to do fifth-grade math." This is not to say that knowledge and culture are unimportant, but rather that the key factor determining an investor's success is not intelligence but psychology. To succeed in the stock market, one must overcome the weaknesses of human nature such as greed, fear, and ignorance. Livermore even said that a normal person entering the stock market is a mistake. So, how does a normal person trade stocks? Most people have two approaches. First, they seek a guru to recommend stocks. Second, they rely on insider information or rumors. These methods cater to human nature's desire for easy gains, cheapness, and laziness, seeming straightforward but actually being ineffective. In this book, Livermore firmly opposes these two methods. Let's first address the point: can stock trading rely on experts? In most fields, to excel at something, one needs to consult experts and often follow their guidance entirely. For health, see a doctor; for legal issues, consult a lawyer; for car repairs, visit a mechanic. However, this principle fails in the securities industry. Stock investment is not like treating illnesses, handling lawsuits, or fixing cars where authority and experience guarantee correctness. Even a company's CEO, possessing all the internal information, or a Nobel laureate in economics, understanding economic laws thoroughly, may not necessarily profit from the stock market. The stock market has its own logic, and unless one can consistently make money from it, one cannot be called an expert. Even a stock market guru, with a profitable method, might not predict a specific stock's rise or fall better than a monkey flipping a coin. Livermore once went bankrupt by relying too much on an authority's opinion. In 1907, he made a fortune by shorting cotton futures, earning the title of the new Cotton King. The old Cotton King, Thomas, then invited him for a meeting and proposed cooperation. Thomas was as renowned in the cotton market as Steve Jobs in the tech industry today. Despite Livermore's prowess, he approached Thomas like a fan meeting an idol. However, they had opposite views on the future of cotton futures. Livermore, seeing Thomas as smart and sincere, decided to follow his advice. This change in strategy led to losing millions of dollars he had previously earned, marking another personal bankruptcy. Thus, while an authority can offer advice, they won't take responsibility for your wallet. Relying on authorities means losing personal judgment, leading to more significant losses even if some gains occur. All right, we've understood not to rely on authorities. Now, can one rely on insider information? It is often said that the capital market is a battlefield of information, where information is key to opportunities and profits. For example, if a company has major positive news, its stock price will rise. If one knows this before the announcement, they can buy early and wait to profit, right? This is not necessarily the case. Firstly, using insider information for profit is illegal today, leading to fines and imprisonment. Even in times when it wasn't illegal, Livermore refused to listen to any rumors or insider tips. Even if a friend sincerely shares the information, even if the friend has staked their entire fortune, it doesn't guarantee the information's reliability. Why is this? Firstly, the insider information you get is likely false. If a stock has good news, why would the person spreading the news not keep it to themselves to earn a hefty profit, but instead share it with you? There are often internal interest groups spreading false information to sell stocks at high prices to small investors. Yet, some people still believe it and bet their fortunes. Secondly, even if the information is true, it is difficult to profit by the time you receive it. For example, if a company's business improves and revenues increase, insiders will know first. Will they immediately announce the good news? Insiders will keep the news secret, buy in advance, and only release the news after securing their positions to reap profits. Thirdly, insiders will only tell you when to buy, not when to sell. Whether the information is true or false, early or late, you are still relying on others without a personal profit-making method. Even if you make short-term gains, you will lose them in the long run. Livermore himself avoided insider information, but his wife once got burned by it. A company's president secretly told her about major positive news, saying, "I respect you a lot, so I'm only telling you." He assumed she would inform her stock trader husband, whose funds and influence would drive the price up, benefiting himself. However, he miscalculated. Livermore's wife, having recently made some money, wanted to make more by trading stocks without her husband. Within days, she lost all the money and had to tell her husband. Livermore laughed, saying, "That's the stock I recently shorted. I had already judged it would plummet." This shows the difference between Livermore's wife and Livermore himself. One relies on authority and insider information, while the other trusts only personal judgment.